welcome to Foxon Media Digital. My name's Amy, and today I'm joined by Dinah Koehler, who's Director of ESG Research at FactSet. So welcome, Dinah. It's great to have you on the channel.
Thanks for having me. So a couple words on myself, and then let's get into a discussion. I currently am at FactSet, joined earlier this year as the Director of ESG Research. My background is heavily into research, if you will, having worked at the EPA in a research management job, having done a lot of thought leadership at Deloitte, and then when I was at UBS Asset Management on the Sustainable Investment team, again, wrote a bunch of papers, a webcast, presentations. So thought leadership is kind of a running thread through my life. And I got in very deeply into this whole topic of sustainable investment whilst doing a doctorate at Harvard School of Public Health. And my dissertation was on capital markets and environmental risk. And we'll get into that a little bit in this discussion, because a lot of what sustainable investment is or should be about is understanding that risk and then reducing, mitigating, or avoiding that risk, depending on what role you take as an asset manager. So that's a little bit on me.
Yeah, thank you for that introduction. And of course, you were at ESG New York last week at our summit. And it's great to have you sharing your experience again in this interview. So just before we dive into some of those specific themes, can you tell us a bit about the general trends and the challenges that investors are faced when it comes to sustainability? Because like you said, there's so much to unpack there.
It is quite significant. So when I think about this, I think about it from the standpoint of our client at FactSet. So our main client is R&D, the asset managers for ESG. And at the core of what they're supposed to be doing, if you will, is figuring out how to build a well-performing sustainable investment strategy. How do I do that? The problem right now is, whilst trying to do this, they're facing a lot of regulator pushback across multiple dimensions. So what comes to mind is the need to prove that, in fact, you are doing what you say you do in your prospectus, which means that if you say I'm incorporating or integrating ESG, you actually have to be able to prove it. So what we've seen over here in the United States is the SEC taking that on behalf of, the investee, i.e. the investing community, if you will, and fining various different asset managers because they are not properly, let's say, complying with their own stated strategy. We see the same happening in Australia, and generally we see financial market regulators raising their eyebrows and saying, are these asset managers actually misleading their clients potentially, or are they following what they say in their stated prospectus? So that's one part, the financial market regulators. Then we see actual regulators in the European Union, and everybody's talking about this, so I'm sure the audience is very familiar with the whole EU taxonomy movement, which identifies what is a quote-unquote green, if you will, technology, such as renewable energy or any kind of energy efficiency technology. And this is where it gets tricky, thresholds of performance. So they not only do they tell you what type of technologies are quote unquote green, that's the product side, they're actually also stating that when making or producing a product, you have to abide by certain standards of performance. By which I mean carbon intensity, how many metric tons of carbon are you emitting in your production process, normalized to unit of output. But they don't just stop with carbon, they're going into standard kind of environmental protection issues such as air pollution and water. So now all of a sudden, you as the investor are not only supposed to be targeting a green investment in your sustainable investment strategy and being able to prove it, but you also have to show that any kind of company in your portfolio actually is quote unquote sustainable and performing to regulated thresholds of performance. And that is tricky. That adds a whole new wrinkle to both the data that is required to make that assessment and the skill of the person who's using that data. Then we've also got additional kind of pushback in terms of the kind of data disclosed. This is driven by the EU primarily, but we're seeing the same across the world in Asia. We're seeing it here in the United States with the SEC climate disclosure rule, which is the need for standardized data and reporting and disclosing. This is on companies, right? In a standardized manner. So there is this whole kind of regulatory push that is both beneficial to asset managers because it is pushing for more standardized data from corporates, but it's raising the bar on how and what asset managers do and how they communicate to their clients. Then we get into, you wanted to respond?
No, no, go ahead. I was going to say
Okay.
there's a lot
So
of themes
then,
that you can see running through
yeah.
here, so we'll get into that in a minute.
And then, so the other issue, I mean, just right now, when I look at data and when I think about data and when I think about our clients, we're relying on voluntary data right now, which is unstandardized and it's very, very hard to use. So let's say you're trying to build a passive strategy, an ETF, and you're trying to find data on several hundreds of companies. Huh? How do you do that? What do you do when you're missing any data? How can you evaluate companies? Because none of them disclose on all the different data fields that you might be interested in. So it's that inconsistent disclosure and the gap, and then how they disclose data is also not standardized. So it makes it really hard to compare company to company on carbon, on water, on labor issues, and on it goes. So for the passive strategy team, if you will, they end up relying on scores, which is an amalgamation of any data available that then is giving you a signal of what the underlying performance may be. Yet here too, we're seeing regulator pushback against the rating. So all of this is now in turmoil, and the asset managers kind of have to ride through this, as do we as their data provider. So the last kind of angle here is politics in the United States, and people are following this too. We see the pushback against ESG very much because of the desire to protect oil and gas interests. So various states in the U.S. have put in new laws that prohibit the public pension fund from considering ESG factors. However, whilst trying to implement this, let's say the state votes, yes, we're going to, try to reduce ESG investing of our pension funds, our public pension funds, several states figured out this was so costly they didn't pursue it. So there's again all this turmoil going on in the United States at state level, while at federal level, we've got Biden and the administration, pushing and creating incentives to go into more renewables, electric vehicles and such. So over here, it's quite exciting. Our clients, and this is my last kind of closing on these challenges, our clients have to stay the course because they invest globally, of course, and they have global clients themselves. So they have to navigate what is a very uneven playing field, if you will. But wisdom usually is you manage to the highest standard, because that tends to be often where the market ends up going. So you can try to get by with the lowest common denominator and kind of coast. Some asset managers will likely do that, but I think essentially they have to, the bar is raising. So either you get with it and move up in terms of your expectations and how you communicate and how you build strategies, or you may be in trouble down the line.
Yeah, it's quite a playing field, as you say, to navigate. I think whether they're domestic or international, there's so much going on right now. So it may be an open-ended question. I'm sure this is what everyone's asking themselves right now. There might not even be a set answer. But if I'm an asset manager, I'm trying to avoid fines. I'm trying to stay compliant with the EU taxonomy. I've got global operations. I'm operating in different jurisdictions. I'm trying to deal with the backlash against ESG in the US. I'm trying to deal with all of this and still perform well at an ESG level, as you say, and still meet those client expectations. What can I be doing? I take it a lot of it will be data management, strategy focused, and when it comes to reporting as well. Like, what else can I be doing to try and make my way through all of this?
Indeed. And so that really raises the question, how do you fix this? Which is a big question, huh? And you've already said it. So the standardization and mandating of corporate disclosure is absolutely essential. And we see this across the board when you're trying to run a climate scenario, climate risk scenario. And the answer or the conclusion is usually we don't have the data. Well, the data has to come from the corporates, right? It has to come from the banks who invest in the corporates. So it's this whole kind of food chain that has to then feed data into the ECB and other federal reserves or banks that are now being asked to look at this in a systematic way. So at its core, it's about the data that firms, both public and private, are collecting and providing to the market. And we know for a fact that they do a lot of this already under current environmental regulations and current health and safety regulations. So the data is, in fact, in a lot of these companies, but they have to aggregate it globally now in a single report. And that is where the complexity comes in. And then they, of course, now are supposed to get that assured at a minimum, if not audited, which raises a whole other problem in terms of how do you audit non-financial data? Who should be doing this? No? So when I think about, again, back to our clients, the asset managers, to really fix, quote, the problem, if you will, it's not just about the data, it's what you do with the data. How do you figure out what really matters? How do you incorporate that into your portfolio construction? And how do you fully understand those risks? And that's where it gets really challenging, because to assess those risks, it's a scientific problem first. Oh, the climate is changing. Why is it changing? That is not something a CFA will answer. That is something a climate scientist will answer, for example, right? So what we need to do is bring in more expert opinions into the asset managers, into the banks. And this is happening now, slowly happening. So I have a scientific background, right? So today, when I talk about this stuff, it has a very different resonance than when I was talking about this, 7 years ago when I joined UBS, right? So I was a lone wolf in a way talking about science. No? Today, everybody's trying to somehow become a scientist, which is not easy. So it is actually better to solicit expert opinion, create science-based analytical frameworks that are linked to economic models. And we see this in climate change, right? That's the whole point of the IPCC, right? And their models. And we see the scenarios and they spit out an economic, outcome, be it energy prices or supply demand, etc. So we see that in climate change. We don't see it in any of the other dimensions per se in the financial sector. So we don't see for any other type of pollution. However, that knowledge is there. There are a bunch of economists who have for years been building these types of models and assessments based upon water pollution expertise, based upon toxic chemical risk assessors. So those experts are there. They just need to be tapped into. So it's not just getting the right data, it's how do you interpret and use the data from a risk angle, because what you're supposed to do as an asset manager is, build return, deliver return whilst minimizing risk. Huh? And it's the minimizing risk angle of this whole problem, if you will, that we have yet to fully tackle in a robust way.
Yeah, and this may be a hypothetical situation, but if the ESG ratings, which are currently facing a lot of criticism from the regulators, they're really honing in on how accurate they are. If they could incorporate those science-based frameworks and, more of that data from the corporates and the banks themselves, do you think that that would solve the problem as a whole and really kind of give those ratings the credibility and the accuracy that we're looking for?
Well, what does the science tell you about? What are the scientists trying to do? They're trying to evaluate problems where they occur. And just, to make it very simple, they're running around with measuring technology, measuring air pollution concentrations. Like friends of mine at Harvard School of Public Health, they sent out kids with a monitor in their backpack because we were worried about to what degree our children, who are very vulnerable, whose lungs are still growing, to what degree are they exposed to hazardous air pollution? No? So at its core, there is a measurement going on, which then is what the scientists use to interpret and understand what's happening and why. That's the role of the scientist, no? And so getting to the core of where the problems are happening in the real world, as the building blocks of anything in ESG, is critical. And then you roll that up to what companies are affected, both are they creating the problem or are they being affected by the problem? You can imagine this very well in water, right? You're polluting the stream, the companies downstream have to deal with your pollution, right? Or you emitting air pollution, the people and companies downwind have to deal with your air pollution, right? So all of that are the building blocks that then you can, it's all numeric, right? You can aggregate, you can develop scientifically informed weightings to then create that rating, right? So it's more grounded in what is or is not a problem, how big is the problem, rather than just aggregating a bunch of different metrics and then kind of trying to figure out how to weight them. So if we did that properly, and it is being done, there are people who do this, certainly those ratings would be more robust because they're telling you about real, how should we say, real changes to the underlying problem, i.e., humans and ecosystem.
Yeah, absolutely. And if we have those in the works, as you say, and we've got those robust ratings that create a bigger picture view of what's really happening, how will that change investment making decisions? Will it kind of create a more holistic strategy? Will it mean that it's simpler? Will it be easier to meet the requirements in theory? I know we can't say this for sure, but what do you think will happen?
Well, it creates a much more rich world, I would say, both data rich and relevant. So when you are looking at this data, you should be able to understand. It's like drilling, through to the source. You should be able to understand why and where a problem's happening at a facility, what it means, and what the corporate is doing about it. That's the sweet spot. Because a lot of these ESG issues are location specific. Climate change, while it is a global pollutant, if you will, has effects at a specific location. And that's the new frontier. So, from an investment decision making process, if you had rich data, if you really kind of incorporated those scientific measures of change, if you think of it that way, real physical change, right? When you make your investment decisions, they should flow through to the physical location and actually trigger a change. And that's what this is all about. We don't just want to be, shuffling money from one place to the other. We want to know that our units, our dollars invested are actually making an impact at a point in time, at a place. And that's magic, right? That's what we're about here. And then I imagine, when we think about our clients on FactSet, we bring together all kinds of data. That's what we're known for, right? So you would have all different types of data sources at your fingertips, and your job is to be informed as possible as the investor or the person trying to figure out whether or not we're going to bring this stock into our portfolio, as well informed as possible on the multitude of different data to be able to read news articles, to be able to understand in an aggregate level how much risk is embedded, if you will, in how this company is being run and managed across E, S, and G. And then, of course, bring it together from different sources, be it satellite data, right? Be it risk models. This creates that information-rich world that would make sustainable investing both exciting, meaningful, and impactful.
Well, you've definitely inspired me, and I think you've laid out some really great solutions for the future, long term, as well as, like you say, highlighting what FactSet is already doing with the data that does exist and that can be aggregated. So, thank you so much, Dinah, for shedding a light on that and giving a really holistic perspective to this really challenging industry issue that a lot of asset managers are dealing with right now.
Thanks for your time.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.